In the last weeks, Ethereum rallied quite a bit. But is that rally over? Historically, we are now close to an all-time high in the decentralized finance total value locked metric. So how much is Ethereum actually been used on chain? So that's what we see in this historical chart. We had the DeFi summer in 2021. Then the market subsequently cooled off massively. In October 2023, we turned around. Now we are very close to those old heights. Is the market now heated again? Can Ethereum still outperform? Now, there are a lot of different ways to look at the situation. This is the Ethereum US dollar chart on a logarithmic scale. I personally like to look at relative valuations. US dollar charts don't really help us that much because the overall macro, as in Bitcoin and the altcoins, they also move prices. And so Ethereum moves in tandem with those assets. But the central question we want to ask is Ethereum a better crypto investment versus, say, Bitcoin or versus many altcoins? And we do not get the answer to that question just by looking at the US dollar chart. A better chart is here, for example. This is Ethereum relative to Bitcoin. And it has been trading in a range since 2016. We did get initially our breakouts. But in the last 7 years, we had times where Ethereum was cheap versus Bitcoin or where it was expensive versus Bitcoin. And the tendency, just based on this chart, is that Ethereum tends to be cheap. The potential risk is a loss of 25%. The potential gain is close to 300%. But of course, if things were that easy, we could already finish this video, call it a day, and all become rich. Unfortunately, things aren't always that easy, right? We have to look at more data. We have to look at how much adoption happens over time for Ethereum. What are the long-term holders doing? We're going to look at the data most people usually do not consider. Now, this Ethereum price rally that we saw in the last few weeks was actually not that much of a surprise to us. Because when we look at the metrics called the Ethereum dominance, so we look at how big is Ethereum within all of crypto, we did reach a historical bottom and we bounced off exactly from that bottom and we made money from that. So that's this chart over here. This is the Ethereum dominance. Again, we see a trading range. It bottoms at 7%, it tops at 20 to 21%, and this bounce that we saw in the last few weeks. This was no surprise because we reached exactly the same levels to September of 2019. Now, Bitcoin is close to its all-time highs, and that's not because a lot of retail investors are buying into Bitcoin. It's not because everybody is now storing their Bitcoin in hardware wallets or buying up Ethereum. The reason for those high crypto prices is demand by Wall Street, mainly through the ETFs. We are seeing that for Bitcoin. So in the last month, if we annualize the inflows, we get to a supply absorption of 2.4%. But then the demand for Ethereum ETFs is even larger than that. If we annualize here the recent purchases, that's 6.3% of the entire Ethereum supply getting absorbed by the ETFs. Pretty much every single day, we now see purchases through Wall Street. And so this gives us a first hint of what the next rally could be, because the Solana ETFs might start very soon. Here are the first news: SOL rebounds, and that's because 7 spot Solana ETF applicants updated their documents to also include staking. And what we see over here, this is now Ethereum relative to Solana. Now, Ethereum didn't do too well compared to Solana in the last months and potentially years. That's because of all of the Memecoin trading that happened on Solana. But Memecoin trading is a player versus player game, and most people lose money in this. Thus, the capital concentrates towards a few winners, and naturally, as there's no new people coming into the space, naturally, the trading has to slow down after people lost their money. But still, the Memecoin trading did fuel Solana, and so Ethereum underperformed versus SOL. But if now we see finally an approval of a Solana ETF, we might one more time see Solana doing even better than Ethereum. And this ratio could go further down. Solana could outperform Ethereum. Even though Ethereum itself is historically relatively cheap, Solana might be even cheaper. Again, because Wall Street could buy up Solana potentially at higher rates than Ethereum. Now, in September 2022, Ethereum moved from proof of work to proof of stake. So before it was possible to mine Ethereum just by selling computing power with GPUs. That then changed. Now Ethereum has to be staked in order to gain more Ethereum. And so the staking gives some reward, but when Ethereum is used on chain, the token also gets burned. And so the circulating supply of Ethereum initially went down because there was simply that much usage of the chain. Since the middle of April of last year, the Ethereum chain itself doesn't get used that much anymore. And so now the supply of Ethereum tends to grow. So the stakers get all of that value, and the usage of ETH is that low that this is a net negative for all the Ethereum holders that aren't staking. This is again Ethereum relative to Bitcoin. This arrow over here marks when the move from proof of work to proof of stake happened. So it was not good for Ethereum. So ETH underperformed Bitcoin by 71%. This vertical line that we see over here, that's the move where Ethereum started to become inflationary again. And so we see that the negative momentum just accelerated with the reduction of the usage of ETH. But again, we recently bounced off a support. And so that then begs the central question: will Ethereum see enough usage directly of the chain? So I'm not talking about the layer 2 scaling solutions, not about Arbitrum or Optimism or Polygon. Ethereum itself, will it get enough usage so that the supply might potentially shrink, so that in the end we see an increasing Ethereum price relative to the other cryptocurrencies as well? What we see over here is the number of active addresses for Ethereum long term. We saw a nice adoption curve up until 2018, but since then the number of active addresses is quite constant. Here we've got the number of new addresses, a very similar chart, and here we've got the number of transactions. Again, very similar. So in other words, Ethereum runs on a somewhat constant user base, on a somewhat constant activity. It's not growing that much anymore. It's not shrinking that much anymore. And so we're likely going to continue to see a similar supply expansion. Now, the supply expansion isn't too bad. It's still less than what Bitcoin is expanding at. Now, in 2018, the Bitcoin inflation will get cut in half again, right? We will see another halving. If Ethereum by that point will also update its tokenomics, that's a big question. Maybe it will in order to stay competitive. What we see over here is the transfer volume on the Ethereum chain. And obviously this spikes a lot during bull markets because both the price is high, but also activity, the trading activity is high. Once the price goes down and the trading activity goes down, then the transfer volume crashes extremely. So this is an interesting indicator just to see when might it make sense to exit Ethereum. Currently, we are not high at all. Activity is low and the price isn't at all-time highs either. Here we've got the mean gas price. So that's now measured in Gwei or in Ethereum. So just technically, Ethereum did get more efficient, but of course, over the long term, the price still appreciated. And so measured in US dollars, the gas used is slightly creeping up over time. And of course, that creates the incentive to use those layer 2s, right? A lot of the active trading now happens on Arbitrum. The long-term holders still believe in Ethereum though. So you can stake Ethereum, right? You can get the additional supply allocated to us. The token inflation is an advantage for the people that lock up their capital. And the tendency, even though we did go sideways for a while, tends to be up again. So the number of Ethereum that gets locked away increases, which is good for the price. Now, why did Ethereum underperform that much when it moved from proof of work to proof of stake? I think there are two reasons for this. The first is simply that there was a lot of anticipation towards that event. So it was to a degree a sell the news event. Many people bought Ethereum in anticipation of this improvement to the network. Once the improvement arrived, it makes sense to take profit. The second reason, though, is probably that all the people that came into the system through mining, that maybe had a computer, a GPU, and they wanted to get some additional money just by mining Ethereum, all of that influx of new traders, new investors, that suddenly stopped. And so when there's no new people coming into a system, of course, this is not great for the price. And that probably propelled a lot of the negative momentum of Ethereum. Coupled with all the inflows from the Bitcoin ETF, with all the adoption of Solana Memecoin trading, that was the headwind for Ethereum. But now we've got even faster inflows for the Ethereum ETF than for the Bitcoin ETF. And now the Memecoin trading for Solana tends to slow down. But again, Solana might outperform ETH in the next weeks or months if the ETF gets approved. And so the miners got a lot of rewards every single day. Then came the move from proof of work to proof of stake. All that miner subsidy fell away. And even without the miner subsidy, the people that support Ethereum long term tend to now make less compared to the hype times in 2021. There is a very nice metric to time Ethereum, and that's just the psychological anchor point, as in how much percent of the Ethereum supply is currently in profit or in losses. And whenever there aren't too many people that are in profit, so when it's only 25 to 50%, so the majority is in losses, that's a good time to buy. Currently, unfortunately, depends on where you are, many people are in profit, 75%. It's better to buy when the majority is in losses and when the Ethereum dominance is very low. But still, we aren't yet at 100%, so there is some more room to grow. I am rather bullish on Ethereum, at least for the next weeks and months, not necessarily for the next 5 or 10 years. And that's because all the whales that bought Ethereum very early, they are gradually exiting. Yes, Wall Street is buying, but have a look at the number of Ethereum addresses with at least 10,000 ETH. That's going down since 2021. Have a look at the number of ETH addresses with at least 1,000 ETH. That's going down since 2018. Here's the number of addresses with 100 Ethereum going down since 2020. Here the same for 10 Ethereum going down since 2023. And here with 1 Ethereum going down since 2022. So even the very small wallets, right? Only 1 Ethereum worth, a trend that tended to go up constantly, that turned around 3 years ago. So a bet on Ethereum is now either riding the current momentum or betting on Wall Street buying more. It's not necessarily more usage. Retail is exiting gradually. Retail isn't using Ethereum directly anymore. It's using the Ethereum layer 2s, but it's not using Ethereum itself. Neither for transactions nor for holding. The system we live in is truly fascinating. Some people don't know anything about finance, and of course they get robbed because of inflation. Then there are some people that know a thing or two about investments. They might buy stocks and property and crypto, and they feel like they're getting ahead. And of course they do versus the people that don't invest at all. But in the grand scheme of things, within the system, they're still falling behind. Now, because of the ever expanding money supply, because the monetary base is increasing over time, the dollar is devaluing, we are forced to invest. And the current narrative is to simply get this into stocks. We might even be forced to buy stocks via retirement plans. The money supply is growing, and people think by buying stocks we are getting ahead. This is the S&P 500 over time. This is the money supply over time. Both charts go up, but the S&P 500 relative to the money supply isn't really going up that much. This chart starts in 1959. And if you bought at the exact wrong time, you could have lost 75% of purchasing power. Effectively, by buying stocks, we just protect ourselves against the monetary expansion. But what that means is that we're giving away all of our purchasing power to the big corporations, to the big companies, to then use this productively. And we don't have any way to do something productively, right? We're already buying the stocks. The money is gone. I think in the grand scheme of things, this is bad for the economy because capital concentrates in the hands of a few companies and in the hands of a few mega billionaires. It's really monetary expansion that's driving all of the asset returns. Have a look at the S&P 500 relative to the gold price. So now we've got two assets that are impacted by monetary expansion to the same degree. We did not see any outperformance of stocks versus gold over the course of 90 years. We can also take this reference point over here. Again, pretty much no return over the course of almost 100 years. Here is gold relative to the money supply. The chart starts in 1959. And again, can we really say that gold long-term outperforms or underperforms? It's just going in line with monetary expansion. And so it's no coincidence why Bitcoin got all of that adoption, right? Bitcoin was started during the global financial crisis. And during that time, the monetary base expanded extremely quickly in order to bail out the banks. Now, why did the banks have to get bailed out? It's because of fractional reserves. So the bank doesn't have to hold all the money that it claims to have. When you've got $1,000 in your bank account, the bank might only hold $100. They're simply speculating on you not withdrawing all $1,000 at once. If the majority of customers decides to do so, we've got a bank run and the bank is going bust. Just think about what kind of a scam that is, right? Imagine you were to buy a car, but you don't have enough space in your garage. So you tell the dealer, just keep the car at your place. And whenever I want to drive the car, let's say it's some kind of luxury car, a sports car that you only drive on the weekends. Whenever I want to drive the car, I just come to you again and I pick it up. So that's a deal that you've got with the car dealer. And then that car dealer sells the same car to 9 other people. And the only thing that the dealer is speculating on is that those 10 people will never want to drive the car at the same time. You don't really own the car. You only feel like you're owning the car. But the exact same car is owned by 9 other people. And that's the exact same thing that's happening with the banking system. You've got all of those dollars on your bank account, but the bank doesn't own those dollars. There is fractional reserve. It is legalized fraud, and it's simply developed historically, because historically there were banks that had claims on gold and nobody wanted to withdraw their gold out of practicality all at once. So in the end, the banks figured out we don't have to hold all the gold. We can just issue the claims. As long as people don't claim their gold all at once, everything is fine. That's now happening with the dollar. With stock investments is that we give all our purchasing power to the big corporations that then use this productively just to escape this hidden tax, the debasement of the money. The problem with Bitcoin, though, is that we still have volatility. Bitcoin got created over here in January of 2019. So again, this is the S&P 500 relative to US money supply. We've got our .com bubble, the subsequent bust, then a slight recovery, and then the global financial crisis where the banks got bailed out. The very first block that got mined in January 2009, it had a message referring to a Reuters article that discussed the second bailout by Chancellor Merkel at the time. So that was in Germany. But since that global financial crisis, we never really saw a real correction in the markets. We did have COVID, but COVID was comparatively small. So again, the S&P 500 relative to US money supply, here we've got COVID, but we had a very quick recovery since then. So during the entire lifetime of Bitcoin's history, we never really had anything major happening to the system. Now, the reason why this is a problem is because we do not know what's going to happen with Bitcoin during a major correction, especially since now more and more Bitcoin is moving towards Wall Street, towards people that just see Bitcoin as another risk on play. At the top, again, we've got the S&P 500. In the middle, we've got the Bitcoin price. And at the bottom, we've got the correlation coefficient of the S&P 500 to the Bitcoin price. So the vast majority of the time, the 1-year correlation coefficient is somewhere around 0.6, 0.7. It tends to get closer and closer to 1. So that means that the two assets tend to move in the same direction at the same time. And so if we see now a sudden sharp decline in the stock market, we are likely going to see another sharp decline in Bitcoin as well. Now, don't get me wrong. I am a fan of Bitcoin. I am a fan of crypto. But that doesn't mean that everything is always smooth sailing. We have to also play devil's advocate. We also have to look at the things that aren't potentially that great. We've already seen how gold is, to a degree, already protecting against monetary expansion. Because even though there are decades where it performs very poorly, over the very, very long term, it tends to just appreciate with the monetary expansion. So gold is already a hedge. And so to a degree, Bitcoin is competing with gold. Even though the volatility is much higher, there are some question marks. So this here is now Bitcoin relative to gold. And in the last 4 years, we really did not see that much outperformance. So this is when Bitcoin hit 63K. This is when Bitcoin hit 100K. And yes, maybe from peak to peak, there was some outperformance. So this is now 8%, but it's not really worth it given the additional volatility that we get. And so because of that, because Bitcoin's market cap is already so high, most people just look for the alternatives in the altcoin market, right? Are there maybe altcoins that are small enough that still have potential upside where you can make the multiple X returns that we saw in the past in Bitcoin? Because in the past, Bitcoin obviously outperformed gold. And while it might still outperform in the future, the relative growth is definitely declining. But then there's the problem with the altcoins. This is now the altcoin market cap, so it's a measure called others. That's a market cap of the altcoins that are not in the top 10 relative to the market cap of Bitcoin. And so if we go more risk on in order to get higher performance, this does not come without risk. So this is an underperformance of 77% since January of 2022. Have a look at those smaller altcoins that might still have some outperformance. This is the performance in the last year. There are 1, 2, 3, 4, 5 winners and all the rest went down. Altcoins are great when a lot of new people enter the space. When people that don't know much about crypto, they want to get the next 10x returns and they buy everything left and right. That's the time to be in altcoins. But we are not there right now. This overview is living proof. And when we look at the number of searches for Bitcoin here in blue or for crypto in red, it's very, very low. So there aren't new people coming into the space. This is not a retail-driven market right now. Just have a look at the best performers in the last 24 hours on the Solana chain. So this is a chain that's very much retail-driven. It's all micro caps. The liquidity in those tokens is less than $100,000 for most of them. And that's after the rally. So before they rallied like this, there were only, say, 10K worth of liquidity. It was pretty much a non-existent coin. And so trying to make money with altcoins in a market like this, I believe, is a mistake. The underperformance is just too constant. And so I just flip the script around. So instead of trying to find the needle in the haystack, the one altcoin that might perform, I just bet on most altcoins doing worse, as they have done in the past. I've also made dedicated tutorial videos on this, how to win in bear markets by shorting altcoins, and why we might not be in a bear market because Bitcoin is close to the all-time highs, the altcoins still continue to do worse. And so we can hedge ourselves against the macro, right? We can bet on the altcoins doing worse than Bitcoin. We don't necessarily have to bet on an altcoin going down in US dollars. We can just bet on it going down versus Bitcoin or versus Ethereum. And of course, we don't want to do this with assets where there's a lot of attention. We don't want to do this with SPX 6900 or Virtual Protocol. We want to do this with tokens nobody is looking at. All those constant underperformers. And so I'm sharing the trades that I do in premium. The link is down below. It's thebitcointrader.com. This is also where you find those tutorial videos. Here's a message how I closed my WorldCoin relative to Ethereum short. And in the end, this made quite a bit of money if we apply smart risk management and smart leverage. Just have a look at our members, how they're also making money with the exact same approach. So it doesn't really take that much rocket science in the end. We just have to look at the tokens that get neglected, that have increasing token supply, and that tend to just underperform long term. Essentially what we're doing is we are flipping this screen around. So every red bubble becomes green, every green bubble becomes red. And this works phenomenally in a market where there is no retail interest, because Wall Street doesn't buy those micro caps. This is all just retail demand, and retail demand is low and will likely continue to stay low until we see massive new rallies in Bitcoin again. When Bitcoin is at 150 or 200K, things might turn around. But in the current market, I take the occasional 50, 60, 100% every now and then, and I'm happy with that. And so if you've been losing with altcoins over the last few months and you're looking for a new strategy, then feel free to check it out. It's down below. It's thebitcointrader.com. It's currently $125 per month. The price is lower compared to the bull market. In the bull market, I did increase the price. If you're now locking in the 125, that's your price. So even in the next bull market, when I will increase the price again, you will continue just paying that rate. Whoever signs up for the low rate will keep the low rate. Now, a link to premium should directly pop up over here on the screen. Feel free to just click it. It will bring you directly to the sign up page. If it's the very first time over here, feel free to subscribe as well. I publish this regularly. A like would be very much appreciated as well. See you next time on YouTube or see you in premium. Cheers.